Wall Street sold investors a simple promise: higher income, less panic, no flashing red stock chart. The money would go into private loans, companies would pay interest, and investors would collect steady cash. For years, it worked. Then people started asking for their money back. And that is when the awkward part showed up. The loans are private. They are hard to sell quickly. And many of these funds were never built for everyone walking toward the exit at the same time. So the question is not whether every loan is going bad. That is too simple. The question is worse. What happens when a giant lending machine has a tiny exit door? Slightly sarcastic. This sounds like rich people fighting over rich people debt. Beautiful. Let them fight in softer chairs. But this machine does not just sit inside Wall Street. It helps fund companies. It helps private equity buy companies. It sits in portfolios used by pensions, insurance companies, wealth managers, and income investors. If this machine slows down, the damage does not need to announce itself with a stock market crash. It can show up as fewer loans, stuck companies, weaker dividends, and investors suddenly learning what limited liquidity means in real life. Private credit? In 30 seconds. Private credit is lending outside the normal banking system. A company needs money. Instead of borrowing from a bank, it borrows from a private fund. That fund has collected money from investors who want income. The company pays interest, the fund pays investors. Simple machine. Money in, loans out, interest back, fees collected. Nobody needs to pretend this is more elegant than it is. After 2008, banks became more restricted, but companies still wanted loans. Private equity still wanted financing. Investors still wanted higher income. Asset managers looked at this and thought, finally, a product where everyone gets something and we get fees. Private credit grew because it was faster than banks, quieter than public markets, and easier to sell because the price did not scream at you every morning. The calm was not magic. It was structure. If a stock falls, everyone sees it immediately. If a public bond sells off, the price moves. But private loans do not trade every second. Their values move through models, assumptions, manager marks, and very serious PDFs. That can make the ride look smoother. Sometimes it really is smoother. Sometimes the dashboard is just slower at showing the potholes. The catch was always the exit. These funds often own private loans that cannot be sold quickly without pain, so many products limit withdrawals. Investors can request cash, but the fund may only let a certain amount leave each quarter. That limit is called a gate. A gate is not automatically scandalous. The rules can be disclosed, but the interesting part is not that the door exists. The interesting part is when a crowd starts forming in front of it. Now look at what happened at BlackRock's H-Lend fund. Investors reportedly asked to redeem around 13% of the fund in one quarter. The fund agreed to repurchase only part of that. Again, the point is not that the fund broke its rules. The point is that investors asked for more cash than the structure was willing to give them at once. That is the tiny exit door becoming visible. And BlackRock is not the only name in this story. Other private credit and private market funds have also faced redemption pressure. We don't need to turn this into a roll call of every fund with a headache. One pattern is enough. Investors who once wanted access are now asking a different question. Not how do I get in? How fast can I get out? To see the machine in one company, look at Pluralsight. This was not some tiny mystery startup. Pluralsight is a software learning platform. Vista Equity bought it in 2021, when money was cheaper and software companies were still being priced like every subscription business came with a halo. The deal used more than $1.5 billion of debt from investment firms instead of traditional banks. That is private credit in action. Then the world changed. Rates rose, software valuations fell, growth became harder, free and cheaper learning products added pressure. The debt became heavier. The company's performance weakened, and eventually, Vista was reportedly in talks to hand Pluralsight over to its creditors. That is the whole machine in one company. Private equity buys the business, private credit finances the deal. The company struggles, the lenders move closer to control. Pluralsight does not prove every private credit loan is bad. That would be lazy, but it shows the mechanism. When rates are low, the debt looks manageable. When growth is strong, the story works. When rates rise and growth slows, the same debt starts eating the room. The investor who thought they owned a calm income product now has to ask a very different question. What exactly is inside this fund? Withdrawals are one problem. Less new lending is another. According to reported figures, U.S.-focused direct lending issuance fell sharply in the 3 months ending May. Normal person translation? Lenders are writing fewer checks. And if private credit funds write fewer checks, companies and private equity deals lose a major source of money. This machine needs flow. New money comes in, funds lend it out. Companies pay interest, investors receive income. Private equity sells companies, cash comes back. Then investors commit again. That loop made private credit look stable. But if investors ask for cash while new lending slows, the machine has to protect itself. It keeps more cash, it lends less. And less lending starts creating problems outside the fund. This is why the problem is bigger than one redemption headline. Private credit funds protect cash, so they lend less. Private equity gets less financing, so deals slow. Exits slow, so investors get fewer distributions. Investors get fewer distributions, so they commit less new money. Less new money means the private credit machine has less fuel. Nobody needs to blow up on live television. The pipe can just clog. Private equity gets pulled in because private equity loves borrowed money. A private equity firm buys a company, often with debt, then tries to improve it, refinance it, sell it, or take it public. That model needs lenders and buyers. If lenders become cautious, deals slow. If buyers demand lower prices, sellers hesitate. If sellers refuse to lower prices, exits clog. Now companies sit inside funds longer than planned. That creates another problem. Distributions. Distributions are just cash returned to investors. When private equity sells a company, investors get money back. That money often gets recycled into new funds. But if exits slow, cash comes back slowly. If cash comes back slowly, investors become less willing to commit to the next fund. Then fundraising weakens. Then there is less fresh money for the machine. The clog starts feeding itself. And nobody wants to be the first person to admit the old price was too high. Sellers want yesterday's valuations. Buyers want today's discounts. Lenders want more safety. Investors want cash back. Everyone waits for someone else to blink first. Very patient. Very professional. Very expensive. Private credit is hard to see from the outside. So look at its public cousin, BDCs. A BDC is a publicly traded lender to private companies. It is not the exact same thing as a private credit fund, but it gives the market a daily vote. If investors thought private credit was perfectly fine, BDCs should look attractive. High yields, public prices, daily liquidity, and yet the market has been questioning them. Reuters found that dividend coverage among U.S.-listed private credit lenders has become thinner. In simple language, some of these lenders are paying dividends with less cushion than investors would like. And when you strip out non-cash income, the cushion looks even thinner. That is not a guaranteed disaster, but it does explain why public investors are not blindly rushing into high yields. A fat dividend looks less comforting when the market starts asking how much of it is actually supported by cash. BDCs are not the whole video. They are the warning light on the dashboard. Private funds can feel opaque. BDCs trade in public. And the public market is not saying, everything is fine, please continue. It is saying, show me the cash. This is where the phrase semi-liquid becomes less friendly. Semi-liquid means investors may get periodic chances to redeem, but the assets underneath are not necessarily easy to sell quickly. That is fine when everyone is calm. It is less fine when investors start reading the redemption terms like they're trapped in an airport lounge with no flights leaving. The product can promise access, but not unlimited access. The loan book decides how easy that promise is to honor. To be clear, this does not mean every private credit fund is doomed. It does not mean every borrower is failing. It does not mean a crisis is guaranteed. Strong managers can survive. Some loans will perform. Some investors will keep allocating. Markets can stabilize if growth improves, rates ease, or buyers return. This is not a prediction of collapse. It is a warning about structure. The real risk is not that every loan fails. The real risk is that the flow reverses. Investors want cash back. New investors hesitate. Funds preserve liquidity. Lending slows. Private exits slow. Distributions weaken. New commitments weaken. Then the machine slows again. It is not one dramatic event. It is a loop. And once that loop turns negative, the calm income product starts feeling much less calm. The payoff. Wall Street did not build a magic safe income machine. It built a private lending machine that worked as long as money kept moving. The assets were private, the marks were smooth, the exits were limited. That looked fine when investors wanted in. It looks very different when investors want out. Private credit does not need every loan to fail to become fragile. It only needs enough investors to ask for cash at the same time. And right now, the entrance is getting quieter, the exit line is getting longer, and the product sold as calm income is starting to remind everyone of the oldest rule in finance. A locked-up asset only feels safe until you need the money.